All right. Hello, gentlemen. Thank you so much for joining us here today. For those of you who don't know, my name is Paul Gray, and I'm a managing partner at a value-based hedge fund here in New York called Ironhole Capital. And joining me today are two very special guests. I will let you guys kindly introduce yourselves. Charles, can we start with you?
Sure. I run a shop called Value Works, mostly large cap value stocks, but we'll go anywhere in the capital structure. A couple of $100 million in assets under management, half in a pooled vehicle that goes long and short. The pooled vehicle tends to be 125, 130, 140% long and 10 to 40% short. So we have 1x beta. The thing I like about how we've done over time is that we have a 20-year track record on the hedge fund strategy that's done roughly 2 times the market over the 20 years. So $1 million has become 14, and the S&P it's become 5.
Right. Wonderful. Those are great returns. So let me introduce you to Evans, who's going to help us raise millions of dollars soon. Evan, can you take it away?
Sure. How much or how little would you guys like to know?
Everything.
My wife will warn you, that could be hours. Long story short, my name is Evan Katz. I'm managing director at Crawford Ventures here in New York City, a graduate of the Wharton School and Harvard Law School, actually same class as Michelle Obama, small world. Practiced intellectual property for a while, been about on Wall Street for about 15 years or so, mostly in alternatives, hedge funds, private equity, venture capital, and so forth. Sat on the Hedge Fund Association board of directors for about 6 or 7 years or so. Have about 50,000 subscribers to our hedge fund email newsletter, and about 16,000 LinkedIn connections, and about 1,000 relationships with endowments, foundations, fund of funds, and high net worth families with about $6 or $7 trillion of capital. And of course, the website is www.crawfordventures.com. That's the short version.
That sounds like an amazing Rolodex. I'd love to take a look at it someday. So we probably have a lot of the same friends. You probably know Mitch Ackles very well, Jabil French.
Mitch Ackles, yeah, we served on the board of the HFA together for roughly about 6 or 7 years, and go back probably at this point, maybe about 15 or a dozen years or so, give or take. Great guy.
Yeah, those are amazing people. So you know what, Evan, we'll start with you. One of the questions I know a lot of the fund managers have on today is, what techniques do you have in mind when it comes to raising capital? And what do you look for really when you're looking for the best fund manager? We had Anthony Scaramucci on the show recently. One of the things he told me was he looks for the X factor. He looks for fund managers that have a substantial track record and proven strategy, much like Charles here. So I'm curious to know, what do you look for?
Sure. I mean, it's a fair question. The short version of that is I am looking for the exact same things that the 1,000 investors we know and work with are looking for. So I basically put myself in their shoes and say, what would their reaction be? So, the joke answer is a bad track record and a couple of felony convictions. But aside from the joke answer, it's pretty much exactly what you'd expect. Good team, good track record, good infrastructure, compliance operations, at least relative to their size, meaning, if they are a so-called emerging manager with a couple $100 million, we know they're not going to have the infrastructure that a multi-billion-dollar shop is going to have. But in addition to helping funds raise a lot of capital, or as part of helping to raise funds, get funds to raise a lot of capital, we often help with things like compliance, trading, organizational issues, better service providers, team building. In other words, if there's 24 things that are needed to get a hedge fund to the $1 billion mark and the fund only has a half dozen or a dozen of them, we'll help them put in place what they're missing as part of sort of the holistic process, to make them sort of investor worthy. But basically, good team, good track record, good compliance and operations. And if they laugh at my jokes, even better.
Perfect. Well, that's a good tip to follow then. And Charles, someone who has actually built a successful fund over a long period of time, what advice do you have for the emerging managers listening today when it comes to building the best team or the best business?
Be true to what you know and what you do, and just put as few obstacles between yourself and success as possible. And to me, that means, just be honest about what your strengths are and what your weaknesses are, and then go about and do your job. Because there are a lot of people who try to make it doing something they're not good at, and that just never works.
Right. And Evan, I would imagine over the course of the years, you probably have spoken to thousands of fund managers. So what are the most common mistakes that you have seen when it comes from a marketing or operations perspective?
Sure. Yeah, we actually see we get about 200 to 300 emails and calls a year from every hedge private equity manager around looking for the first billion, the second billion. Well, let me back up a little bit. Probably the best bunch of tips I could give folks listening or watching is actually a presentation that's on our website, on the Crawford Ventures website, about halfway down. It originally was called How to Raise Capital from A to Z, 26 tips, tricks, and best practices from the industry. It's now in about its fourth or fifth year, and therefore I think we're roughly at about triple C, which is about 55 tips, tricks, and best practices. So I won't go through them all in the interest of time. But if anybody is interested on the best ways of raising capital, it's about halfway down the Crawford Ventures website. I think it's around the same place you can sign up for our newsletter. But probably the biggest mistake I would say that most fund managers make is they don't have enough operating capital for their business. So in other words, the great thing about alternative investments is, you can get into it with two guys, a gal, a dog, and a Bloomberg. And it's extremely easy to get to first base, so to speak, in baseball terms. The challenging part, though, is it's much harder to get to second, third, or home. So a lot of people start their hedge, venture, private equity firm, whatever it is, and then they discover they don't have the resources to hire the compliance, the operations people, a top fundraiser, whether that's me or somebody else, doesn't matter. And they stay at very low asset levels for decades sometimes. And it's a horrific chicken and egg problem. Constantly managers say, well, I don't have the AUM to afford a compliance, operations, or fundraiser. Can't we outsource everything?
Right.
They then outsource everything, but investors honestly don't really want to be allocating to funds that are outsourcing everything. So the only solution that we've ever come up with, or we've never heard of a better one, is very simple. If you're trying to get your firm from first base to second base to third to home, and you don't have a couple of $1 million of operating capital, pass the hat to your friends, your family. We call them the 4 Fs. Your friends, your family, the former investors, your former colleagues, people who know you backwards and forwards, know you're brilliant, smart, and honest, and raise a couple of $1 million for your firm so you get some operating capital. Now, the pushback we get sometimes is that a lot of fund managers would rather give away their firstborn, their secondborn, and their spouse versus ever giving up any equity in their firm, even to friends and family who seed them or invest with them. But you don't need Excel. You don't need to PhD in finance from Stanford to realize that it's better to have 70 or 80% ownership of $1 billion shop than 100% ownership of a 50 million, 5 million, or $100 million shop. So the long answer to your question, Paul, is the biggest mistake we see are folks that get into the business, which they can do, having no idea how they're ever going to grow their business or get the capital to do it, or they're being so pig-headed they won't give up any equity, to raise the operating capital to get them to second and third base and home.
Amazing. Right. And if you look at some of the most successful hedge fund managers today, whether it's Ken Griffin or Ray Dalio, even those gentlemen gave up large portions of their business. And as you can see, it paid off pretty handsomely.
Yeah, I've often said, even pick any analogy you like. Bill Gates, Steve Jobs, Jeff Bezos, pick your favorite CEO, did not become billionaires because they own 100% of Microsoft or Apple or Amazon. They became billionaires because they now own whatever the numbers are. I'm guessing 20, 25, whatever it is, of $1 trillion company. And at the appropriate point, they gave up equity to get them to the promised land, so to speak. So, I would say that that's probably the number one mistake, we see. There's a ton of other mistakes we cover in the fundraising PowerPoint on our website, but that's probably the biggest one. And that's pretty much a deal breaker, because if you have no operating capital, you're never going to attract talent, because, when investors say they want you to have a good CFO and good people in risk and a couple of good analysts, nobody good is going to join your shop if you're running on fumes and don't have either the AUM or the operating capital to know that that's going to be a good career move for them. We certainly wouldn't take on something like that. So that's the number one answer.
Exactly. Okay, excellent. And going from an investment perspective, Charles, we were speaking to Joel Greenblatt recently, the famous value investor. And when we asked him what he thought about the value industry, he said, in light of where we are in the market today, he expects there to be a big comeback likely to take place soon if there is that market correction. Just curious to get your thoughts on that and if you expect the same as well.
I'm 100% sure that value will outperform after a speculative, excited market top. But I just don't think we're near that market top. And I think we will get to that speculative, excited market top. And I think value will underperform into that speculative market top. I think, I lived through the 1990s and I invested through the 1990s. And, I know what a top looks like and feels like. And I don't think we're there. And I don't know why anyone thinks we won't get there. I think the setup is for 3 to 7 years from now, or maybe a little longer, we're at a really exuberant, excited, hyperbolic economic environment and market environment. And it'll be really fun. But it won't be fun for value guys. It'll be fun for the guys who are running and gunning. And I think that's quite a way away from us.
Interesting. Okay. Well, in the event there is a market correction, Evan, would it be a lot more difficult as it is perhaps today or years ago in regards to raising capital?
Sure. Well, I guess the first question is, or two questions, is there going to be a market correction? Some would say, will there be a market correction? 99% of people in this world can't time the market. I am certainly in that 99%. But I will say this, the numbers are, some numbers are not great. 1/3 of Americans and American families, 1/3 of them are facing possible or potential issues paying their rent or paying their mortgage and eviction and foreclosure. That's a staggering number. I'm not sure how the poll defined how worried they are, but that's a pretty bad number. Right. 1/4 of Americans and American families say they are not sure they can meet basic necessities. So, there are, a lot of challenges out there. Obviously, there are a lot of companies that do great regardless of conditions, some very fundamental companies whose products everybody needs, basic commodities and staples. And there were also some hedge funds that really are very low correlated to some very global macro factors, whether they're just great stock pickers regardless of markets, or whether they've got some great quant technology or arbitrage funds. So as a former recovering lawyer would say, Paul, in answer to your question, it depends. I've often said things are never as good as everyone says they are when they're good, and they're never as bad as everyone says they are when they're bad. In the great markets, the bottom quartile of funds are having a lot of trouble, and in horrible markets, the top quartile of funds are doing great. So, I guess, the bottom line for investors is it's always important to pick your money managers. And for money managers, it's always important to pick your stocks or your commodities or futures, whatever you're trading. But I think that there will be some sort of correction. There always is, as much as I'd love it to go on forever the way it's been the past 5 or 6 years.
Well, I would say that, what we saw a year ago served as a bit of a correction. That was a pretty sharp, harsh downturn. And it's a year behind us. Mm-hmm. And yeah, we're at record highs, but don't discount how impactful that sell-off was.
Right. Absolutely. And I'm just curious, Charles, are there any sectors of the market that you think present a good opportunity for value investors like you and I? What areas of the market are you guys looking at today?
We are very, very heavyweight energy right now because of the damage that was done to that sector a year ago. And the valuations on some of those are up multiple folds from where we put money to work, but they're still down multiple folds from any normal metrics of valuation. So as a big sector, energy's up there. But we try not to be as much sector specific as security specific and look for individual opportunities. And I'm not afraid to call my shop Value Works, but our portfolio, we think, is full of growth stocks that are trading at value prices. And I think that's the right strategy for today's environment. But that's really very, very comes down to picking securities.
Tell me about that. In your experience, how has value investing changed from when you first started? Because it seems like more investors today are looking at growth.
When I was first starting to brand myself as an investor, I really didn't like the term value investor for myself. I didn't think it was what I did because I didn't focus on dead businesses trading cheap or crappy businesses trading at low multiples. I tried to find really great businesses that were trading at discounts to what they were worth. When you frame value as the bottom half of the valuation continuum, which, look, if you look at a value index, it's the bottom half of the valuation continuum. And that's going to always be, heavily weighted towards industries that trade at crappy multiples, whether it's financials or tobacco or airlines or.
Mm-hmm.
But I don't think that's value. I think value is caring about the price you pay for something and knowing what the thing is worth in the real world, and then understanding what price you're paying for it in today's security price. So in that definition of value, none of it has changed even a little bit since I started investing in 1980 something.
Very nice. It's like what Mr. Buffett always says, right? Value and growth are really attached at the hip.
Yeah, for sure, because something's not worth something without understanding what its growth parameters are. If it's a crappy business that's going to be worth less a year from now and less a year after and less a year after, then that's rarely a good investment opportunity.
Right.
Absolutely. And Paul, I'd say one more thing to Charles's point. You mentioned it before about sticking to your knittings, and the old expression, know what you do and do what you know. Mm-hmm. Out of the roughly couple hundred funds a year that have knocked on our door looking for investors and to grow AUM, which is well over a couple of thousand over the past decades. I mean, there are value investors, there are growth investors, there are funds that do quant momentum, that do mean reversion, vol arb, stat arb, a wide variety. Some are market neutral, some are long biased. I could go on and I won't. But the bottom line is, what's that old expression? Continue to do what got you here. Obviously, you don't want to be completely blind with your head in the sand. If you're doing a certain trade, a certain carry trade, for example, that has literally gone away, you better react quickly in advance and find a new trade. But I would say that out of the roughly 1,000 institutional and family offices that we know pretty well, most of them try to avoid the flavor of the month, what's in vogue, what's not. Some of them do. Let's face it, investors get wrapped up with funds that have done great in the past 2 years and chase returns, and some investors get wrapped up in what's hot, what's not. But the vast majority of the folks we work with, the institutions, the endowments, the pensions, the foundations, most of them are looking for quality managers, regardless of labels or the flavor of the month. Yeah, some will chase the latest fad or fashion. But if being a growth manager or a value manager or a quant or mean reversion, if whatever CTA, whatever got you here, stick to that, because you'll do a lot better knowing what you do, and not going to do well if you keep trying to change and have so-called style drift.
Exactly.
And I would build on that point, Evan. You're very, very right. Look, we didn't name our shop Values the Best. We labeled our shop Value Works. And it's not the only investment discipline that works. And it's really, really important to have a stable of managers that do different things, because when market cycles go to extremes, and they do, if you're all in value and value is underperforming for 5 years, like I think it will for the next 5 years, you're going to be throwing in the towel right at the top for growth. You're going to throw in the towel for your value guy at the top of the growth market. You're going to switch to the growth guy right at the wrong moment. The having a balanced portfolio and a balanced structure of different managers is so helpful in dealing with the problem that Evan just said. You can't time the market. You can't time when these things are going to come in and out of vogue. And if you do try it, you're going to end up going through periods where you underperform so badly that you're going to be tempted to change your stripes. And that's that's where you lose as an investor.
Interesting. Well, Charles, let me ask you this. When my partner and I were forming our fund, we went to go speak to Joel Greenblatt and get his advice. And one of the things he said to us is something he says very commonly on all his interviews. He said, you really want to look at the unbeaten path. And based on my partner's exceptional experience in India, we started looking in that market because I'm not sure if you're familiar, but in places like India, there's less than 500 hedge funds and mutual funds combined in comparison to the United States, Evan, which has well over 15,000. So we've been finding a lot of opportunity in Asia. I'm just curious to know, have you guys started looking there as well? Oh, this is for Charles.
Myself or Charles?
Charles.
Oh, I'm sorry. You know, do what you know, and I'll tell you what I don't know, and that's, India and Asia, and I barely know Europe, and I know a little bit of South America. I know U.S. companies pretty well, and a lot of U.S. companies are not U.S. companies; they're global companies. When we look at what the U.S. market is doing, you know, in the big names in the U.S. market, it has very little to do with the United States of America. Amazon and Apple and Google and Facebook, these are global. So I know global companies and I know U.S. companies. And, every now and then it becomes really tempting for me to go afield. And I'm happy to do that with a couple of dollars in the portfolio when we can clearly get an asset at 50 cents on the dollar and really take advantage of an opportunity when there's a dislocation in a faraway market. But it takes a lot of something really extraordinary for us to be willing to go that far afield because we have to stay with what we know. And so I think that probably creates a lot of opportunity for folks like you, Paul, that do have an expertise in a market and can see where things are dislocated in that market.
Well, I wish I could take credit, but I'm really here for business development and marketing, Evan, so you'll appreciate that. But I have to ask you this, Evan, what makes the best fundraiser? Because I've always been curious, once a fund manager gets to a certain size and level, if you're Charles Laminius or Andy Scaramucci or David Rubenstein, does it come to the point where it's so easy where you could just simply walk in the room and say, hi, I'm so-and-so. You see me yesterday on Bloomberg, CNBC, Reuters, everything. Just give me money. Does it ever get to the point where it's that easy or no?
I think there was a little bit of that going on, a little bit of that going on maybe about 20 or so years ago, 15 years ago, before the crisis. And look, there are still certain people who've already made it to that point. But the bottom line is this: if you've made it to that point, you don't need help fundraising usually. But the 99.9% of managers who are not famous on TV every day type of thing need help extensively. So Paul, in answer to your question, what makes a great fundraiser? Well, I guess a couple of things. First, obviously, they've got to know investors real well. Sometimes a lot of funds, hire some junior person to do the fundraising job. And there is simply no way that a junior person can have deep 15-year relationships like we do and other people do as well, when they've only been out of school a couple of years. No way in a million years are they on a first name basis with 1,000 allocators and $6 trillion of capital. Right. So the first thing is make sure you hire a man or woman with gray hair, no hair, or at least something, someone who's got relationships that are a dozen, 15 years in the making. The other thing is also, finding someone who knows the investors that are going to be applicable to your fund. So, there's a lot of classic mistakes that people make. An emerging manager hires a great fundraiser, but the great fundraiser came out of a $7 billion shop or a $10 billion shop. And all they know are some of the endowments, foundations, and sovereign wealth funds that write $250 million tickets, 99% of whom won't allocate to a $200 million manager. So I guess the long and short of it, as we say in the hedge fund business, number one, get a fundraiser who's been around a long time, has deep relationships with very many investors, but especially somebody who has relationships with the type of investors that will invest in a fund with your style and strategy and a fund of your size, and if it makes a difference, of your geography as well.
Well, I think that Rubenstein guy said that the first 100 billion in assets raised was the hardest one. And inside of that, the first 10 billion is the hardest. And inside of that, the first billion is the hardest. And inside of that, the first 250 million is the hardest. Mm-hmm. And I remember when the first 50 million was the hardest. And I remember when the first 10 million was the hardest. Mm-hmm. And I remember when the first million was the hardest. You have to build a structure and an organization and relationships with people that make sense for you as an organization. And I think Evan's point is spot on, that you have to have relationships with people that make sense for you. And the other thing that Evan said early is build partnerships with people, whether it is by giving them equity, or by including them in your organization, or by building deep professional relationships where you treat each other like partners. And then you get better quality people helping you grow your business. Because if you have to be the top dog in every relationship, then everyone else is going to have less capability than you do, and that means your growth trajectory is going to be more limited.
Very well said. And for my next question, I was really curious to get your take, well, both of you actually, to see whether or not institutional investors today are more prone to allocate capital as they were perhaps before, or now in light of the pandemic, have they slowly started putting the brakes on? Maybe Evan, do you want to start with this?
Yeah, sure. That's been my life for the past 15 months, along with a lot of other people. I guess to state the obvious, which I'm pretty good at because it's obvious. Obviously, March, April, and May of 2020, people were just trying to figure out, are my kids going to school? What the heck is COVID? What's an N95 mask? Can I go to the grocery store? And what the heck's going on? And how do I survive this thing? However, since then, I've been working 80-hour weeks pretty much the entire year since. Allocators, if you ask them in January 2020, would you ever give $50 or $100 million to a manager you never met before? They'd say, you're out of your mind. Of course not. You should have your head examined, not in a million years. That changed. Over the course of the past year, allocators have allocated to countless managers they've never met in person before, during the height of the pandemic. Now, that said, a lot of those allocators knew at least one or two people on the team, the PM, the CFO, the fundraiser. So it wasn't just, somebody they literally had no relationship with or had never met before. And that's part of it. I mean, if you just graduated B school, had never been in the industry for 15 years and tried to launch a fund during the height of the pandemic, I mean, good luck with that. That was pretty crazy. But everyone's had Zoom for the past year. We've done more manager and investor calls and emails and everything over the past year. It's been great, great gangbusters. And, it used to have to be where, when Charles or a manager was trying to get a meeting with an endowment or a pension or a foundation, we're going to be in New York or California or Hong Kong in a couple of months. We'll see you then. And that was basically it. Now it's like, okay, we'll hop on a Zoom today, tomorrow, next week, the week after, and we can sort of advance that ball, sort of take it, to use the football metaphor, kind of take it 90 yards down the field between the emails, the virtual data rooms, and the Zooms. And yes, I mean, now post-COVID, we're going to meet in person at some point. But at least we've sort of got things teed up, to mix sports metaphors, teed up at first and goal on the 10 when we do have that meeting in New York or Chicago or Hong Kong. So I think going forward, it's going to be a hybrid of the two. To paraphrase Mark Twain, the death of the in-person meeting has been greatly exaggerated, but we can certainly use Zoom and virtual data rooms to move things and expedite them greatly before we have that in-person meeting for the first time.
Charles, in your opinion, have institutional investors been allocating capital like before?
We as a $250 million shop, 200 million depending upon the day, haven't been ready for institutional money until now. We've done a lot of groundwork saying hello to folks over the past 5 years, but we haven't been ready for that spigot. So. And the past year for sure is not one where we're trying to open it, especially, a year ago, the portfolio was the only thing I was thinking about. Mm-hmm. And, now that a year's gone by, we can start thinking about whether it's time to raise assets or not. But, the other thing is, as Evan said, very, very few people were committing fresh capital last April, May, and June.
Sure. Yeah, these are changing times. But, on this subject, Evan, I'm curious to see what are your thoughts on the 506B, 506C? Do you recommend a fund go one certain way? Because I heard different perspectives on this, and often people disagree. What do you recommend funds do today?
Yeah, sure. The 506B, 506C has turned out to be a great Talmudic debate. I'm not sure how many clear answers there are, but for those listening or watching first, let me just clarify what 506B and 506C refer to. It used to be since the beginning of Dawn that private fund managers, hedge, venture, private equity managers could not, quote unquote, advertise their firm. It was a private offering. The securities were exempt under SEC rules because it was a private offering. And because of that, they couldn't go on television and talk about their funds. They couldn't take an ad in the newspaper about their funds and so forth. And then under the Obama administration, we had in the States enacted what's called the Jobs Act. It's an acronym like every other good piece of legislation, the Jobs, Jobs Act, which allowed small businesses, or any size business, I guess, for that matter, including alternative funds, to basically, quote unquote, advertise, if you will, so long as they confirmed before taking people's money or institutions' money that they were accredited or qualified purchasers. So it's kind of a weird situation where you're still running a private fund, but you can still advertise it so long as you make sure that your investors are accredited or qualified. So basically, there was this huge debate about whether funds should go that route or not. The SEC pretty much admittedly has said they weren't thrilled about the Jobs Act, or at least they weren't thrilled about the Jobs Act as it applied or did not apply, arguably, to hedge fund managers. I think the SEC, and this is pretty well documented, they may not have said it publicly. The Jobs Act was great to help small businesses, mom and pop businesses grow capital and succeed. But the notion of hedge funds and private equity funds weren't exactly what the SEC thought should be doing with this. But it is the law. And so to answer your question, Paul, most funds, the vast majority, are still doing private securities offerings under 506B. They haven't gone the 506C route. And I think the critical thing is this: if you're going to try to raise money for any type of alternative investment fund, you're not going to be raising it at the country club and with doctors and dentists typically, or at least not a lot of money. And you're not going to raise it by being on television and maybe CNBC, I don't know. So I think people have to make up their own minds. I think the trick to raising capital, and it's really no surprise, is to hire a great fundraiser, whether it's me or somebody else who knows 1,000 allocators for 15 years, who, I say we have a secret weapon. My secret weapon here is this thing right here. It's called a telephone.
I almost didn't recognize it.
Sorry?
I almost didn't recognize it. What year is that?
This is called a telephone. No, and I will pick up the phone and I will call investors whom I've known for 5 to 15 years. And surprise, surprise, if someone who knows investors for more than a decade makes a couple of hundred phone calls to allocators they've known for a dozen years or more, you will likely raise a lot of capital. Whereas if you put an ad in the local newspaper or in your church or synagogue newsletter, you're probably not going to have the same effect. So, the only thing I think 506C really can help with, though, is it does take away the risk that your PM, your CIO at your hedge fund or venture fund, won't commit a foot fault if they're doing an interview. So, if you're a manager speaking at an investor conference or on CNBC or Bloomberg or to the press, it used to be you had your compliance lawyers waiting in the wings, and they were they'd make you wear like an ankle bracelet with a shock collar. And if you started to talk about your fund or your fund's performance, they would press a button and you'd get a shock to remind you that you're not allowed to talk about your fund or your fund's performance. Yep. And I'm exaggerating a little bit for hopeful comic effect, but that was literally how it went. And if a manager was in the habit of talking about his or her fund, and who doesn't love to talk about their fund, their kids, their grandkids, and their fund's performance, you could be breaking the private offering rules if you do that in a public forum. So, if one does 506C, I guess the bottom line is the Jobs Act version, you don't have to advertise. You don't have to take out the Super Bowl ad. You don't have to put an ad in your church or synagogue newsletter. But if you do happen to be speaking publicly, if Charles is speaking publicly and mentions that his fund was up this much last month or last year, if he's a 506C fund, he hasn't committed a foot fault, and his lawyers and compliance people will probably sleep a lot better. But I think if there ever was one thing that had massive expectations when it came out that has been used by very few people, it's been the Jobs Act. I've read the statistics and people can Google it. The number of funds doing 506C has still been very few and far between. And it does mean, by the way, just to be clear to people listening or watching this, that you do have to now verify that your investors are accredited or qualified. Yes. Under 506B, the way it used to be for decades, they could what's called self-certify. So if a pension or endowment or a family office wants to invest in your fund, they check a box that they're accredited, they check a box that they're qualified, and the fund has no obligations unless it has reason to know that the person isn't. truly qualified or credited. But absent any red flags, they can take the investment. Under 506C, they do have to quote unquote verify it, but it's not that much work. You can have an investor's accountant certify that the family's accredited. And, we work with a lot of endowments, foundations, and pensions. And, it's really not that difficult to verify that, teachers of this or firemen of that or Harvard, Princeton, or Yale actually do have a net worth north of whatever it is, $5 million. Obviously, their worth is north of $5 billion. So the long answer to your short question is I don't think that 506C ever became the boondoggle or the floodgates ever opened for 506C as much as people thought. But it is an option if you want to avoid committing footfalls at investor conferences.
Right. I'm under the same assumption as well, because I feel like, putting your offering out there in that way under a 506C would kind of ruin the credibility in the brain, so to speak, of the actual fund itself. So it comes off a little bit different, but that's just my personal opinion.
Well, no, you raise a good point a little bit. Psychologically, there are definitely potentially some who might think that if you're a great manager, you don't air quotes need to be 506C, because it's kind of like the Tom Sawyer picket fence version of hedge funds and private equity funds and venture funds. The less public you are, and there was a little bit of this going on for the past few decades. If you don't quote need to be 506C, maybe you're the better manager. So, I think it's a great 3 or 4 beer conversation I'd love to have with you and anybody else on this call sometime offline. But there maybe is a little bit of this. I know that the SEC off record has verified to me, in kind of a wink, wink, nod, nod, or at least a few people there that, they're still a little bit more skeptical of the 506C stuff. But look, it is the law of the land. And at this point, it's here to stay unless things ever get changed, and they probably won't. So we'll see what happens. I think the jury's still out on 506C.
Exactly. Wonderful. So I just have a couple more questions, and this plays directly into what I see coming here in the chat. Charles, what are your thoughts on inflation? Unfortunately, we can never escape this debate, but do you think it's transitory? Do you think it's here to stay? Do you think it's going to grow from where it is today?
I think there's a very, very good chance it's going to grow from where it is today. And my quip about that I've been putting out there for the past couple of months is that the problem for equities is not inflation. The problem for equities is the cure for inflation. It's funny. Like, I'm sorry, you're afraid of investing in the equity markets, so you're going to keep your money in cash because you're afraid inflation's coming? I'm sorry, you just guaranteed yourself a loss, a negative rate of return. Or you're going to put your money in fixed income instruments because inflation's coming. The best thing to be doing if inflation's coming is buy a third house. Okay, great. Or put money into the equity markets. And if you believe in real estate, you could do that through equity investments too. But inflation went from just about 0 to about 5% from 1960 to 1970. And those are round numbers, and, you could quibble about it. And the equity markets doubled over the window. It's when you try to stamp inflation out that things turn south for the equity markets. And the Fed's telling you right now, and policymakers are telling you right now, that they're going to let inflation run. So, they may well be lying to you, and that happens a lot, and they may change course. But if they let inflation run, tell me what you want to be doing with your investment dollars.
Right. Especially in this expensive market.
Well, listen, parts of the market are expensive, parts of it ain't. A lot of the market's not expensive. I think we're going to have inflation. Look, it's showing up in people's ability to hire workers. You can't hire people today for what you could hire them for 3 years ago. And that's just not just small anecdotal stuff here and there, but it's a big deal. Real estate prices have torqued higher and are highly likely to, maybe they keep going.
Especially with such low interest rates.
Right. And, if the Fed turns around and raises rates, I guess that'll knock inflation off the table and knock down growth. But if they let things run, then Katie barred the door. You better be invested.
And to Charles's point too, I mean, if the Fed raises rates or when they raise rates and how much, how soon. But it also goes to, I think, Paul, your and Charles's point earlier in the conversation of when you're an allocator, the diversification among managers of various styles, whether that's growth or whether, it's quant or whatever the strategies are, I think there's always going to be a place for great stock pickers. I mean, we've seen thousands of managers, when things are moving straight up, due to quantitative easing or other reasons, anybody can be a stock picker when you can throw darts at a bull market. But the famous Warren Buffett quote comes to mind and frequently quoted, people don't know who's naked until the tide goes out. So in terms of diversification among different managers with various correlations to the equity markets or lack thereof, that's always been, a large part of it is diversifying across different styles and different managers, within those styles as well.
Exactly. So essentially you buy deals, not markets. I love it. Another question I see coming in, very common. Charles, are you buying crypto at all? Are you using it as a hedge, perhaps?
I am not buying crypto. I don't know how to begin to get at crypto at a discount to what it's worth. And, my shtick in investing is try to identify an asset and try to control it for a discounted price to that asset. And I don't know how to begin to value crypto except at dollar for dollar, which works for me, sort of. But if I can't get a discount to that dollar, I don't know how. It's probably a big deal. It's probably going to create a lot of a very different economic world 5-10 years from now. I don't think you get to these sorts of market caps without it having a degree of, very realness to it. And I think it might be changing the world around us really, really quickly. I just don't know how to apply my craft against that opportunity.
Exactly.
So I won't.
We're in the same boat then.
I mean, Paul, if I can get up on my crypto soapbox for 22 seconds,
Let's do it.
I think it goes back to it gets back to the conversation about India. I've seen some incredible India market traders. I am not one of them. I've also seen some fantastic crypto market traders. In fact, some of the best returns I'm seeing are in crypto, but also some of the worst. And so, what's the difference between the two? I think is pretty much as follows. I personally would not allocate any of my money to a long-only crypto fund, buy and hold. I don't think you can have a value crypto fund. I don't think anyone really knows which way it's going to go, but I'm pretty certain that one of two things is going to happen. Crypto is going to become the biggest thing since sliced bread and the best investment of all time, or it's going to be the biggest bubble of all time. I think it's going to be one of the two. Maybe it's somewhere in the middle. I could be wrong. I've been wrong before. My wife will tell you I'm often wrong, but I think it's going to go one way or the other, either the biggest boom or the biggest bust we've ever seen. So the managers I've seen that have done the best in crypto over the long term, and obviously, long term in crypto is a relative term, have been the ones who've not been long only crypto. It's the ones that have really been looking at the inefficiencies of crypto. It kind of gets at what, Paul, you and Charles were saying about India. There's a gazillion managers in the States trying to figure out what a share of Apple is worth. It's extremely competitive. India, there's fewer. Not none, but fewer. Should be better opportunities for investors. And the same thing on the crypto side. There are many markets in which crypto is being traded, spot, so to speak. But in addition, and even more importantly, there are increasingly derivatives markets where crypto derivatives are being traded. And some of the best managers I've seen in crypto are not the ones who are long only crypto praying it keeps going up, because praying something goes up is not a great strategy. I don't think Charles uses the prayer strategy, maybe a little bit, but not only the prayer strategy.
Right.
But some of the crypto funds that are doing really sophisticated cross-market arbitrage involving derivatives, the possibilities are there. We've seen some that are making triple-digit a year returns with sharp. One fund has got a sharp north of 5. It's insane, because the bottom line is it's kind of like the equities markets were 50 years ago. I mean, anybody under the age of 60 or 70 has never seen this, but it used to be, I could pick up my telephone 50 years ago or 60 years ago, not that I was trading stocks or alive 60 years ago, call my buddy in London and have him or her check the price of stock and arbitrage that some days, all days, occasionally against the price it was trading at in New York.
Right.
Pure profit, no risk. And, people, unless you're 60 or 70, would think that's kind of quaint, along with rotary dial telephones. That's sort of, back in your parents' and grandparents' years. But those opportunities actually do exist now with crypto derivatives where they're not 100% efficient, either in an absolute sense where there's a guaranteed arbitrage, or it's more of a stat arb situation where there likely is an arbitrage between a handful of derivatives. And we've seen some managers who have been putting up phenomenal numbers in crypto arbitrage for years who are doing just that. Now, how long is the trade good for? I have no idea. Maybe another 2 years, another 10 years, 20 years, 16 months, no clue. But those opportunities are there now for people who are looking for it. But I would not go long only crypto and keep my fingers crossed, hoping it keeps going up.
Absolutely right. And that's interesting history. A lot of people don't know that back in the day, they were using the transatlantic cable to arbitrage stocks in the UK as well as in America. Very similar to what they were doing about 10, 15 years ago with Citadel. They knocked down a whole mountain just to get to the exchange a lot quicker using microwaves.
I think the Rothschilds are the Rothschilds because of carrier pigeons between London and Paris.
Wow, I didn't know that, but I wouldn't be surprised. Amazing. Giving us ideas here.
The world keeps getting smaller.
Evan, I have one more question for you, actually. I know there's one particular strategy that you ask all fund managers to deploy, which utilizes an insurance fund. Can you just explain that to us a little bit?
Sure. Probably if you ever want to never get invited to another cocktail party again, talk a lot about insurance at a cocktail party, you got a pretty good chance you'll never be invited back.
No, I love it.
And I have friends who are in the business. They'd probably be the first ones to confirm it. So, insurance is a weird thing. And in the alternatives community, I've sort of spoken on it with regarding three pieces. One, out of the 1,000 institutional and family office allocators we know, a bunch are insurance companies. So the one piece is insurance companies do allocate to not all, but many alternative investment strategies. And a lot of times people kind of forget about them and they focus on everybody else. So, they're large investors and it takes a while to get the money in, but the checks are big. So that's one thing about insurance companies. The other thing about insurance companies that people often don't realize is that if you're an alternatives manager, there's insurance for certain things about your business, whether it's, major trading errors, investor lawsuits, whatever, that insurance companies can and will cover. And a lot of fund managers forget to look to get insured for those things. And the last piece, and I would say, Paul, to answer your question, the biggest piece that most people overlook is so-called PPLI or private placement life insurance, where high net worth families and family office investors can allocate to alternatives or anything mostly, call it hedge funds, for example, using PPLI. There are some diversification requirements and lack of control requirements, and that's another conversation for another day. But the bottom line is that family offices and family offices and high net worth families can allocate to hedge funds either on a tax avoided or tax deferred basis through life insurance. And there are some hoops you have to jump through, but there's only one thing better in top hedge or alternative funds that are producing huge top decile, hopefully your top quartile returns. Sure. The only thing better in that is if you're a family office or high net worth family is doing that and having it either on a tax deferred or tax avoided basis. And I would probably say the number one thing that people had great hopes for that never turned out was 506C. But conversely, the thing that has the biggest upside that most investors on the personal side never do is PPLI. And if you're living in even if you're not living in a high tax state like New York or California, federal income tax is what it is. So, if you can invest very profitably in PPLI, private placement life insurance, and funds that are using PPLI, some of the biggest families do it, but I think it's the number one thing that family offices don't take advantage of. So I'm really glad you brought that up.
That's amazing. Okay. And the compounding effects must be incredible if it's tax.
Sure. I mean, it's sort of like everybody knows the IRA concept. If you can invest money in an IRA and make X% a year compounding without taxes for 20, 30 years, I mean, beginning when you're young, or even if you're not so young, the numbers are off the charts. And the same thing goes on the PPLI front. And to anticipate your next question, or probably one of the more popular ones is, well, why don't people do it if it's so good? I think it's, I don't know, maybe just lack of knowledge, a little bit of complexity, but not that much. We're not talking about, you need a PhD in nuclear physics to understand. It's not that complicated. And just people are busy. Some of the most successful family offices and high net worth families are busy with their lives, their family, their businesses, their investments. So, it's just the type of thing where, it's on everybody's list of, oh yeah, I heard something about PPLI. And to your point, Paul, wait, I can invest tax deferred or tax avoided and compound. And yeah, it's on their list. They just never get around to it. But, if you're investing substantial money, $5, 10, $50 million in hedge funds, and you can grow it on a tax deferred or tax avoided basis, compounding tax free.
Yep.
Even if you're in a low tax state, it's a massive difference. So thank you for bringing it up.
Oh, absolutely. So you can imagine how well you could do if you have a strategy like the one that Charles has. That could just compound through the roof. Evan, I speak to about 5 to 7 family offices a week through the show alone. So we need to speak about that.
Absolutely. And one last thing I'll say too about the tax issues. Some funds are tax efficient, most aren't. But shockingly, a lot of the funds that are tax efficient, you could be a growth fund that has a lot of long-term capital gains, or mostly or virtually all, or, some of the, options and futures strategies that have 60-40 capital gains treatment. Shockingly, 90% of those funds don't conspicuously mention in their one-pagers and their tear sheets that, yes, we are fund ABC or XYZ, and we've done this great work over a decade or so. Oh, and by the way, historically, 80 or 90% of our returns have been long-term capital gains. So if you are a taxable family or person, we're not just, quote unquote, just making you, in air quotes, 15% or 20% a year. Mm-hmm. We're effectively making you 25 or 27. And I'm shocked at why they don't do it. The only reason potentially I've heard is that some lawyers or compliance people will not let them put that on their documents, allegedly, because, well, next year could be different from last year, or this year could be different from last year. But I said to them, wait a second, if your compliance and legal people will let you put in your documents how you performed the last 10 years, which every fund has, we've been around 10 years here, so we performed every year, with that disclaimer, not a guarantee for next year. By the same logic, how can your compliance or legal people not let you put down, and for the past 10 years, 82% of our returns have been long-term capital gains, next year may be different. I've never gotten a good response to that. So definitely a good idea if you're one of those funds, and I won't put Charles on the spot, if you're one of those funds with long-term capital gains, let people know.
Well, Evan, we're one of those funds with long-term capital gains. And the last time I looked was a couple of years ago, and someone did the analysis and they said 100% were long-term gains. I'm like, yeah, right. I could name all the short-term gains I've taken. Like, yeah, but those were offset with short-term losses. And actually, at that moment in time, we had 100% long-term gains. We don't talk about it that, and one of the reasons, by the way, I care is because, some of the money's mine. And, I sort of care about whether I write that check at the end of the year. But the other thing that's a reality in terms of marketing that is that not all my investors are taxable. So to tell my investors that are not taxable, that actually I'm going to hold something long term because I care for myself and some of my other investors is a sort of mixed sort of marketing message. And, my mix is probably, it's not that different than 50-50 taxable and non-taxable investors. So I don't really want it. I don't know that it makes that much sense for me to put it out.
You're absolutely right. You certainly don't want investors thinking you're managing for taxes. They always say, in terms of the tail and the dog, make your investments for the sake of your investments. Don't try to let the tax tail wag the investment dog, so to speak. And the only exception I would say is, if it's day 364 or 5, you probably want to wait one more day. But except for that kind of extreme hypothetical, you're right. So, Charles, we can talk offline. I'm just sort of brainstorming out loud here thinking, do you have 2 different one-pagers, one for the taxable and one for the non-taxable?
I'm going to go with no.
I don't know if you go that route. Although I do, kind of like Paul's question of if you say 506C, do people think you're not a good fund because you're 506C? Similarly, if you say 86.5% of our returns are long-term capital gains, will investors think, oh, wait, he's thinking more about the tax than the investing? Although maybe it depends how long you've been doing it. If you've been doing it successfully for as long as you guys have, maybe they won't. But that's a 3-beer conversation I'm happy to take offline. But it's an interesting point you raise. Would investors rightly or wrongly think that?
Right.
Beautiful. Well, gentlemen, thank you so much for your time today. That was really good. That was very exciting. Appreciate the information. Charles, with all these family offices here, which ones should reach out to you today?
Only those that really have the stomach to work through volatility. The big knock on our fund is always that we're volatile, and we are. And good investors earn good rates of return over time because they work through volatility. Bad investors, and earlier in this conversation, someone said, well, the investors should pick the managers should pick the stocks. Mm-hmm. When they said the investors should pick the managers, I thought, well, the managers really need to pick their investors too, because the worst is when you're going through a moment like we were going through last year, and invariably, the clients are calling concern. Some of them are adding capital, but most of them are wondering if they're going to decrease their capital, and that's the investor that shouldn't call. The investor that really has the stomach for investing through the cycle, 212-819-1818.
Beautiful.
That's a fair point. And if I could just echo what Charles said, people have this notion that volatility is the enemy. I mean, don't get me wrong. If there's 2 funds, everything else being equal with the exact same performance and one's more volatile, sure, take the one that isn't. But there's rarely that free lunch. You rarely find the best performing funds every month, no volatility except for Bernie Madoff, and that did not turn out very well at all. So there's a $1 billion family office we know very well, and I'm paraphrasing only slightly, that said, we're big boys and girls. You run over $1 billion. We have no problem with volatility if it's a quality manager who knows how to make alpha during market cycles. Mm-hmm. And there's an old expression, or maybe I made it up, I don't know, when everybody else zigs, you zag. And this notion that volatility in and of itself is a 4-letter word, or the enemy and the end of the free world, maybe people should consider that, because few funds do well every month except for Bernie. And if you could find a quality manager that does well over a market cycle, that's great, notwithstanding certain volatility. And one last point too, most allocators, virtually 100%, have a portfolio of managers. So even if fund A is volatile, or fund B or Q or Z,
right,
most managers most investors are not giving all their money just to Charles or Bob or Stacy or Susie. They're distributing it around. And unless those managers have a 0.9 correlation to each other, it's really the volatility of the portfolio you're talking about. And I would say, any family offices on the call, we work with some great managers that have fantastic returns, low volatility, medium correlation, negative correlation. And that's really, what it's all about, because you're not giving all your money to just one manager anyway. So, keep your eye on the ball. And if one manager is volatile and the rest of your ones aren't, it should not be a big deal, probably.
Exactly. Evan, for all these emerging managers here that want to take it to the next level, how can they get in touch with you?
Yeah, sure. I would say, look, we're in the matchmaking business. We work with some of the world's greatest and largest and other investors, and we work with some of the greatest funds that many people have never heard of. So if you're a great manager looking for great investors, or conversely, a great investor looking for great managers, feel free just to shoot us an email, Evan Katz, the email, of course, ekatz@crawfordventures.com. Send us the documents, your contact info. Don't all call at once, because it has happened after events like this. But if you can space out the phone calls, +1 for the States, 212-904-0909. But honestly, the best practice is just send a quick email. We'll schedule a call, because otherwise we get barraged, especially after an event like this. But either way, happy to get in touch. And if we can be of help to a manager looking for great investors, happy to do it. And conversely, if you're a great family office or other allocator looking for great managers, we, for what it's worth, we turn down 99% of the managers that approach us. So the best pitch I ever gave to an investor, according to them, was, before we've shown you 1 or 2 managers, we've turned down 1 or 200, and they like the pitch.
Yeah, I'm sure. Well, I can say from personal experience, you're very good at getting back because I was blowing up your email this weekend. And you
Well,
were
thanks. We try. We do our best. Nights, weekends, holidays, but we're trying to cut back a little on that. But look, you do whatever it takes. There's a phrase I use called polite persistence. I mean, it's a service business when you're working with investors or managers. I mean, every business is a service business. So, return the phone calls, reply to the emails, keep your promises. I always tell managers, tell investors what you're going to do what you told them you're going to do. And if you're ever going to make any material changes, tell them in advance, in writing, and why. And that's all you can do. And, to Charles's point, if it's the right investor with the right fund, it should be a great long-term relationship.
Well, gentlemen, thank you so much again. And Charles, please say to Hedda, I said hello.
Thank you very, very much. And thank you very much for having us, Paul, and arranging this. And Evan, thank you for your graciousness on this call.
No, my pleasure. And Paul, thank you for your excellent questions. They were really terrific. I appreciate them.
Thank you so much.